Decentralized finance, or DeFi, is an emerging digital financial infrastructure that theoretically eliminates the need for a central bank or government agency to approve financial transactions. Regarded by many as an umbrella term for a new wave of financial services innovation, DeFi is deeply connected with blockchain, the decentralized, immutable, public ledger on which Bitcoin is based, that enables all computers or nodes on a network to hold a copy of the history of transactions. The idea is that no single entity has control over, or can alter, that ledger of transactions. Most of the financial services that can be defined as DeFi can be found on the Ethereum network, the second largest cryptocurrency market, which also acts as a platform that allows other blockchain applications to be built on it. Payments using Ethereum's cryptocurrency Ether transaction fee. By using a decentralized application or DApp, two or more parties can exchange, borrow and trade directly using blockchain technology and smart contracts without the involvement and cost of middlemen. It's a fair, free and open digital marketplace, at least in theory. In practice, at least for now, this is not always a reality. To learn more about this new digital financial marketplace. How is DeFi different from Bitcoin? While Bitcoin is a decentralized digital currency that operates on its own blockchain and is used mostly as a store of value, DeFi is a concept that describes financial services that are built on public blockchains, such as Bitcoin and Ethereum, that, for example, enable users to earn interest or borrow against their cryptocurrency holdings. DeFi is comprised of a variety of applications around financial services such as trading, borrowing, lending and derivatives. How does DeFi work? DeFi uses cryptocurrencies and smart contracts to provide financial services to eliminate the need for intermediaries such as guarantors. Such services include lending, where users can lend out their cryptocurrency and earn interest in minutes rather than once a month, receiving a loan instantly, making peer-to-peer trades without a broker, saving cryptocurrency and earning a better interest rate than from a bank, and buying derivatives such as stock options and futures contracts. To facilitate peer-to-peer business transactions, users utilize dApps, most of which can be found on the Ethereum network. Among the more widely used DeFi services and dApps are coins, Ether, Polkadot, Solana, stable coins, whose value is pegged to a currency such as the US dollar, tokens, digital wallets, Coinbase, MetaMask, DeFi mining, aka liquidity mining, yield farming, staking, trading, and borrowing, lending, and saving using smart contracts. DeFi is open source, meaning that protocols and apps are theoretically open for users to inspect and to innovate upon. As a result, users can mix and match protocols to unlock unique combinations of opportunities by developing their own dApps. What is a smart contract? It's computer code that acts as a digital agreement between two parties. A smart contract runs on a blockchain and is stored on a public database and can't be altered. Because the blockchain processes smart contracts, they can be sent automatically without a third party. The peer-to-peer transaction is closed only when the conditions in the agreement are met. The obvious benefit of smart contracts is that they can be created for you to borrow and lend your cryptocurrency without the use of an intermediary, which sidesteps a lot of the risks involved in traditional lending. If, for example, a borrower can't meet their obligations in a loan, their lender can simply take their funds back, making the need for collateral unnecessary. What's more, DeFi saving accounts could function in the same way as savings accounts at banks but might offer higher interest rates or could pay out either daily, weekly or monthly, depending on the platform. Who created DeFi? No one person created the concept of decentralized finance. Bitcoin is said to have been created by Satoshi Nakamoto, a pseudonym for a person, or people, behind the world's first cryptocurrency and financial blockchain. The true identity, or identities behind Satoshi Nakamoto, remain unknown. Ethereum, the Bitcoin-inspired platform where most DeFi services run, was developed by programmer-turned-entrepreneur Vitalik Buterin. In 2013, the 19-year-old Russian-Canadian wrote a white paper outlining an alternative platform to Bitcoin that would enable programmers to develop their own applications using the built-in programming language. Thus, Ethereum was born, and it has grown exponentially over the past 9 years. As of mid-January 2022, Ethereum's cryptocurrency Ether has a market cap of $385 billion. It is the second largest cryptocurrency by market capitalization after Bitcoin, which remains the largest cryptocurrency by market capitalization with a market cap of $805 billion. What can you do with DeFi? As mentioned above, DeFi uses cryptocurrencies and smart contracts to provide financial services without the involvement of banks. With the addition of more dApps, the possibilities of what you can do with DeFi continue to grow. The more popular uses of DeFi include sending money anywhere in the world, in little time and affordably, storing money using crypto wallets, and earn higher yields than at a traditional bank, borrow and lend on a peer-to-peer level, trade cryptocurrencies anonymously and at any time 24/7, trade tokenized versions of investments such as stocks, funds, other financial assets and non-fungible tokens, NFTs. Crowdfunding. How do people make money in DeFi? There's more than one way that people are attempting to capitalize on the growth of DeFi. One strategy is generating passive income using Ethereum-based lending apps. Essentially, users loan out their money and generate interest from the loans. Another strategy being used is yield farming, a riskier practice by more advanced traders, in which users scan through a myriad of DeFi tokens in the hopes of finding opportunities for larger returns, but it is complicated and can lack transparency. How risky is DeFi? Like all other new decentralized blockchain networks trading in cryptocurrencies, DeFi is very risky, especially as you're using a new technology that aims to disrupt an established institution such as a centralized bank. It's even riskier for novices lured by the potential gains of yield farming and passive income. Ethereum has security and scam prevention guidelines, as there are also broader potential risks.